What's up, guys? Jeremy here, your favorite financial advisor, the most trustworthy financial advisor, and most casually dressed financial advisor on YouTube. So, I wanted to do a long form video here and kind of walk you guys through something that I'm thinking about as it relates to the economy and investment decisions, business decisions. And that's twofold, two impacts I'm thinking about. One is recessionary impacts, right? What businesses, what industries might outperform in a recession-like scenario, and another being tariffs. What businesses, what industries might outperform in a tariff-like scenario? And I was thinking about these two questions yesterday, and yesterday I was working on my reselling coaching group. Some of you guys know that my bridge for my personal income as I was growing my client base as a financial advisor was reselling, liquidation sales, buying pallets, truckloads full of returned items to major US retailers, and then flipping those returns through Facebook Marketplace and eBay. So I have this coaching group dedicated to that. And I was thinking yesterday how, man, reselling, it's just such a recession durable industry because it's the cheapest that you could get any of these things, right? If you can't afford to go to the store, but you still need your food appliance or your vacuum or your article of clothing or your grill or whatever it is, you might look at, man, is there a way I could get a used one, right? And so resellers have an advantage in a recession. And resellers, I was realizing yesterday, they also have an advantage in tariff scenarios because all of their merchandise is sourced from the United States, or certainly that's the easiest way to do it. You let the big dogs pay for the manufacturing, you let the big dogs pay for the taxes and the shipping to get it over into the States. But then when the big dogs, your Lowe's, your Amazon, your Walmart, your Bass Pro Shops, when they're liquidating their stuff because they don't want to take the time to go through the returns themselves, when they're just packaging it up, piling it up, and letting it go, well, guess what? You're already stateside, so you can source, right, your product, what you sell, these used items, for a fraction of their retail value, and then you make the spread. Right. So I was thinking about, man, it's a great time to get into reselling. And if you're interested in reselling, I mean, you can head on over to school.com/reselling and talk to me there. But I was thinking about this from an investor angle. Are there publicly traded resellers, right? Are there companies that are taking advantage of this window? Because if there are, this could be an interesting time to own those companies. And one that is quickly became obvious to me is GameStop. And I've talked about GameStop in some videos in the past. And of course, they also sell new video games, new consoles. And in a tariff scenario, the price of new things goes up across the board. Same in a high inflation scenario, right? So if everything's getting more expensive, it increases the demand for, or it pushes more people towards the less expensive options, aka used video games, used consoles, etc. So I was thinking, man, the people that are selling and also the tighter that times are financially, the more sellers there might be, the more people might be getting rid of some of their old games or old consoles, etc., selling them to a GameStop that GameStop can then purchase for a fraction of their retail value or their resale value, if you will, and then flipping them for a profit. So they're potentially getting more sold to them than ever, and also potentially having more people coming and buying from them than ever. To be a reseller marketplace, it's a great time. And they do that with collectibles as well, graded cards. And so that was one, but I already knew about them. And then I thought, are there any others? And I'm like, well, there's Goodwill, right? So I'm not the store experience of Goodwill, not super premium, but I was like, I wonder if they're publicly traded. Nope, they're a nonprofit. Salvation Army, nonprofit. And I thought, what about Plato's Closet? Are they publicly traded? And I Google it, and they're like, no, they're not publicly traded. They're owned by this company that owns five other resale businesses. Their ticker symbol is da da da. I'm like, oh, okay, so you can't own Plato's Closet directly, but you can own this company that owns five different reseller businesses. And so in this video, what I want to pivot into is let's kind of go down that rabbit trail together and see, is this an exciting company? What can we learn about this company? And the company is called, let's see, Winmark, Winmark Corporation. So I want to go through this 10K that I haven't gone through before to see, man, is this an attractive company? Here's what I did do just off the jump, super fast search is, okay, what are the companies they own? So, okay, they own Plato's Closet. They also own Once Upon a Child. Once I knew they owned Once Upon a Child, I'm like, okay, I know a lot of people that shop there for sure. And so maybe there's something to it. And then I thought, what's the value of their company? And I saw, okay, they're just a $1 billion company. So they're very small. They're just a Russell 2000 company. And then I also looked, are they profitable? Do they make money? Period. And yes, they do make money. If you're not a profitable company in a recession, it's not a good time. It's not a good time to be you. You want to be profitable. And I will say, clothes are some of the probably the worst performing industries to be in a recession. So I might not fall in love with this company over this process, but I wanted you guys to maybe get to see what am I looking for, maybe what stands out to me when I am reading a 10K. So if you ever want to analyze companies, if you want to learn how to actively manage, if you want to learn how to pick stocks, how to build your own portfolio, or if you just want to kind of glean from how I do it, maybe you can get some value out of this. If not, this is probably a good time to bounce out of the video because that's the gist of what I wanted to set up on the front end is, man, thinking about with your brain who's in a good position, who's not, and competitive advantages. Close, sector wide, not necessarily a competitive advantage. Compared to in the GameStop scenario, video games are actually very recession resilient, great performers in recessions, very cheap, low cost entertainment value, low cost entertainment for a high entertainment value relative to your in-person entertainment, your concerts, or even movies. Video games perform well. Clothes, I'm not really sure how well they perform, but let's see what we can learn about this company. Okay, so their business, Winmark, the resale company. Look at that. The resale company. Okay, so resellers come here. They are nationally recognized franchisor. Okay, so they franchise out these businesses. That means they don't own all of these locations. They just receive a franchise fee from these business owners. We champion and guide entrepreneurs interested in operating one of our award-winning resale franchises. Plato's Closet, Once Upon a Child, Play It Again Sports, Style Encore, and Music Go Round. Okay, so at the end of the year, there were 1,350 franchises in the US and Canada, and our mission is to provide resale for everyone. Okay, consumer value, high quality used merchandise, substantial savings from retail. This is the reseller company for sure. 30 years old, encouraging people to recycle. I mean, that's a great ethical business model, right? Instead of throwing things away, like actually getting the full use out of a product that's been made. So, very environmentally friendly type business, ethical business, saving our landfills. Oh, this is cool. We estimate that since 2010, stores in our resale brands have extended the lives of over 1.9 billion items. So that's how many things that they have purchased from people that have come to sell them there. They're enhancing their franchise model, trying to support their franchisees, teaching them how to be profitable, etc. So Winmark can be profitable even if a franchise location is unprofitable, but not for long. I mean, they still get their franchise fee, whatever cut they get. I'm sure we'll probably learn that soon. But if the franchisee goes out of business, there, there's no more fee coming. So they definitely want the locations to be profitable. Okay, mostly in the United States. Great. Plato's Closet, store, Once Upon a Child, baby stuff, played against sports, sports equipment. Okay, Style Encore. I guess it's just a fancier Plato's Closet, mostly for women. Okay, no Old Navy there, I guess. And music go around. So here's the breakdown of sales. Okay, so Plato's Closet is the breadwinner, 653, and interesting, and not they're not growing fast. I mean, franchise fees are not going to grow fast usually, but they're growing. Once Upon a Child is growing. Played Against Sports growing. Style Encore as flat can be, as is Music Go Round. Played Against Sports is also basically flat. I mean, this is a slow growth revenue on the top line. So maybe it's not a super exciting business to be in, but we're seeing revenue growth, which is good. I was kind of wondering if Plato's Closet was still kicking or not. But revenue growth in a high inflation environment, as we've been in the past couple years, that's encouraging. That's cool. So they have e-commerce for their smaller three franchises. Great. Royalties. So this is their total revenue. Okay, yeah, this is what the franchise locations are making, and the royalties is what Winmark is making. So they're making what, approximately 5% of revenue goes to Winmark. It's not bad. Net stores open and closed. So they are opening more than they're closing. And a lot of them are renewing. So that's great. Sustainability, franchising, business model. And they have 79 new franchisees opening in 2025. So that's great. That's another thing I was kind of thinking in a recessionary environment is there's maybe more people as they maybe if they lose their jobs that are saying, "Hey, I'm just going to bet on myself. I'm tired of the system. I'm going to open a business." I don't know. 79 is not a huge number, but okay, teaching people what to buy, what not to buy. Initial franchise fee of 25K. So there you go. Once franchisee opens its initial store, okay, 15K for your next stores. Okay, and then Canada. Typically, the initial store is open about a year after they sign the agreement. It's a 10-year agreement. They have to pay weekly, anywhere from 4 to 5% of revenue. Okay. It's not a huge franchise fee, but it's also like probably about as high as it can be because it's just not that hard to make your own. I don't know how valuable the brand itself is compared to if you were to try to DIY, but most DIY resellers, you end up buying, it's hard to, there's so many DIY resellers that go to places like Plato's Closet and try to find the best deals that they can or a Goodwill or whatever, and then they sell them e-commerce wise. So to create your own physical competition of it might be kind of hard to be a specialized reseller. But let's see, they say it's highly competitive. But most of the retailers are selling all new stuff, obviously. Resale, thrift, and consignment shops and garage and rummage sales do offer competition for the sale of used merchandise. And, haha, resellers like me on eBay, Facebook Marketplace, Poshmark, etc. So that is affecting their business. Good to know, right? Okay, great. Random competitors. Let's get to the financials. Any other big things I need to know here? Leasing, trademarks. Okay, now we're just talking risks. Okay, yeah. Pandemics can affect our business. Thanks. We know that. These are how many renewals are coming up each year. They need people to renew their franchises. They need new franchises. Duh. Okay, some equity. Here's Winmark versus the indices over the past 5 years. Look at that. They're an outperformer, just barely, but they are outperforming the NASDAQ as a whole. And then they're also outperforming the retail sector. So you gotta love that. Okay, saying the same things again. Results from operations. This is interesting that they break it down by percentage of revenue. I just want to see the actual statement. So total revenue went down actually a little bit, even though royalties went up a little bit. Why did your revenue go down? Merchandise sales. Merchandise sales includes the sale of product to franchisees through our customer support center. So if the franchisees are not being sold, like if enough people aren't going to these stores selling them their stuff, then the stores can buy stuff from Winmark, and Winmark just keeps stuff in a warehouse to make sure that all their stores still have enough stuff. So yeah, that business is going down, which is a good sign actually. It means that more stores are more fully stocked. They're getting as much inventory as they want from people that are coming to them, bringing them their high quality, lightly used items. So that's actually great. Although the revenue of these stores is not like it doesn't seem like they're necessarily growing. Like it's not exciting from a growth perspective at all, but very durable as a retailer to have revenue increasing from your stores in these difficult years kind of confirms this suspicion that I was talking about at the beginning of this video that resellers are positioned comparative to others pretty strongly in the industry, where other retailers, their income and their revenue over the past couple years has gone down for a lot of them. So that's great. Hey, they brought down their SG&A a little bit, brought down their interest a little bit, paying off a little bit of debt. Okay. So there's the total numbers. 81 million in revenue, or is this in thousands? We'll find out in their real statements. Right? You got real statements? Should be coming up soon. Okay, yeah. Balance sheet. Here's the good stuff. Is this really just in, this is just straight up in millions, huh? Like you've got 12 million in cash, right? Man, this company is tiny. 12 million in cash, another million in receivables, 400K in inventory, another 1.2 in prepaid expenses. Getting ahead of the curve. So 15 million current assets. Looks like they spent some of their cash from a year ago. Pretty flat on their property and equipment. Pretty flat on the rest of this. Liabilities, let's see this. So 1.5 in accounts payable, just down 200K from the year before. Check this out, notes payable. How did they do that? They went from 4 mil in notes payable a year ago to zero. That's a huge debt payoff and only had to give up 1 mil in cash to do it. That's pretty impressive. So their receivables net of their payables is about minus 200K. They also have a million fewer accrued liabilities. So they took 5 million in liabilities off the books in 2024 of current liabilities. No, look at that. And in long-term liabilities. They took another 5 mil off of long-term. Way to go, guys. You like to see that. A little bit of de-risking. They got some liabilities, though. That's for sure. Negative 65 mil. Jeez. That's their retained earnings. Mm. So total shareholders equity negative 51 mil. But looks like they're on the right track. 26 mil in assets, 80 mil almost in liabilities, right? 72 plus 5. You know, that balance sheet is not like amazing. Not amazing, but the business seems like it's like let's see from their operations. So the balance sheet's going to tell you what they have in terms of cash in the bank, like their assets, right? And what they owe, which may or may not describe to you that much about how the business is doing, but it might tell you a lot about where the business is coming from. And so they might have been working out of a hole. I think they did approach bankruptcy many years ago before switching to a franchise model. And so that might be part of the hole that they've been each year kind of working themselves out of. But let's see. Royalties on a great track, leasing income on a downhill track. I think that's because they're owning fewer and fewer of their stores. So instead of franchisees paying rent for the stores, now they own the stores outright as those leases renew, right? Those 10-year leases. So I wonder, like, when did Winmark switch to franchise model? Okay, it was in 2000. So you would think that leasing income would be off the books already, but maybe I'm not. Obviously, I'm not that well in the know yet. 81 mil a year. And it costs them 25 mil is their that's what all their corporate employees make basically. So they're paying 3 mil. All that debt that we just looked at, the long-term debt, it costs them 3 mil a year to finance that debt. But then they're also making some interest income. So their net income is, I mean, it's a classic franchise model. Like your total revenue is going to be pretty low, but a high percentage of that revenue is going to be profit. So their net income is 50% almost of their total revenue. So with 40 mil a year coming in, I mean on an EPS basis, earnings per share, that's a high earnings per share. There's huge companies whose share price is much higher, whose earnings per share is much lower. And so you're kind of getting a trade-off here where the income is pretty strong, pretty healthy. Like, look at this. 39.4, 41, 39.9. And they're slowly bumping up these royalties to catch up with this leasing income finally getting wrapped up, it seems like. So after another year or two, you'll probably see this 39 starts to slowly bump up a little bit each year. But a great defensive name, it's looking like so far as it relates to the health of the company. And you can have a ton of debt if you can if you can keep affording to pay the debt, um, then that's not necessarily intrinsically a risk. But if sales plummeted at stores, then of course eventually that would hurt. But they've only got 3 million shares. Great. Here's their cash flow statement. So there's their net income. They're going to depreciate some stuff, some stock options for employees. Great. So their cash flow is a little bit higher than their net income, which is expected. Financing activities. Look at that. They paid 10 mil. They paid 10 mil. Way to go. How'd you do that? I mean, I guess they're making 40 mil every year. So shoot. They're clearing 40 mil in cash every year. And what do they have? They've only got 80 mil in total liabilities. That's crazy. I mean, yeah, look, their 2023 shareholders' equity was 60K in the red, and then you're at almost 50K in the red just 1 year later. So they are I mean, they're writing the balance sheet slowly and steadily over time. I mean, that's crazy. Their debt's only 2x their income, which is not bad at all. I mean, their debt is like 3x their total assets, which is not nice. I don't like that at all. But they make more in a single year than the sum of all their assets, which is very nice. Which again, kind of classic franchise model. They don't have to have a lot of assets because they don't own all the store locations. So they are just, I mean, they're just making money. They're just making some good money. But then they also, oh, boom, dang, dang. Okay, so dang, why do you pay that much in dividends? I mean, I don't hate dividends. That's pretty nice. Look at that. They got 39 mil in net income, and they're freaking paying out 39 mil in dividends. Why are you doing that? So their net cash is it's in the red. I mean, they're basically just keeping it flat. Okay. Make me feel better about that. What are you gonna say? Yeah, we get that. Direct financing leases. Okay, so maybe they'll lease out. Sometimes they'll put their name on the lease. Oh, and they could even lease equipment as well if a franchisee wants to rent instead of buying their own shelving and stuff like that. Okay. They don't spend nothing on advertising. No wonder their franchise fee is so low. I mean, I guess they don't have to. The stores are making it's like up to each local store to do their own advertising. That is you know, it's kind of bold. I don't hate that. It's one of the best things about being a reseller is you really don't have to advertise because you are the cheapest. You're the cheapest retailer. If someone wants to save money, that's where they got to go. And it's not like a lot of times when you see an ad, it's like, oh man, I'm being persuaded. I feel so drawn. And then you end up spending way more for a product than you otherwise would have. And that's how those companies pay for their ads, right? Is we're going to sell you something that's for a higher price than what it really is worth. And a company like Winmark, they're saying, hey, we'll sell it to you for the best price possible. And there's enough demand for that they don't even really have to advertise. Hmm. Their accounts receivable or their royalties too. Staying kind of flat, proportional to the slow growth of their franchises, is that they also have some receivables. I guess they're probably not, I mean, they're current assets, so it's not like they're defaulting on it. Amortization. Okay, tell me about this. Declared and paid cash dividends totaling 255 per share and a $3 special cash dividend. 2023 cash dividends totaled 310 per share and a 940 special cash dividend for a $33 million total. 2024 350 a share and a 750 special for 26 mil was paid by cash on hand. Oh, okay, so it's 26 plus 12.3. So yeah, almost 40 mil. Why are you giving that big of a dividend? I mean, I guess it makes sense. Like, as a franchise, you don't like, there's nothing they have to do. So they're just sharing the love. It's almost like a REIT. It's like a real estate investment trust where the sum of what they make is paid out to the stockholders. Like, there's intentionally not a growth of retained earnings, but it is like almost like a partnership. Like, whatever we make, we'll split it up. Whatever portion of the this company you own, you get that portion of the earnings. And so they're almost like valuing their income and they're still slowly paying off the debt, but they're like, it's maybe not as aggressive as I thought in terms of, hey, let's build up the balance sheet. Let's get rid of our liabilities. It's more like, hey, whatever we earn, let's just pay it forward and we will boost our investor base that way, which for a Russell 2000, I mean, to have a very small company that's giving, treating themselves almost like a REIT, giving you the option to receive the earnings pretty much as good or as bad as they do, they'll give it to you. It's not exactly like the blue chip method, but you almost feel blue chip-ish in terms of their safety because their net income like is such a high percentage of their net revenue. Like they're making sure that what they declare is pretty low. Like they're committing to, hey, we're going to give a dividend, but that dividend's going to be 28% of our earnings, right? So they're not, even if the year does way worse than they thought, right? They're going to keep dividends at a conservative level and then wait till the end of the year probably and say, hey, whatever the rest is, we can go ahead and pay it out. Um, but they're not committing to the special. It's like the special is just going to be whatever else we earn. But they're committing to, this 350 per share, which in 2024 was just like a 1% dividend. So it's not like a crazy, it's not like you're making a ton of money owning this company. It's weird to have a Russell 2000 that's almost like a safety stock. Stock options. Great. Loans. So this is in 2022 they did these things. Decreasing debt slash extending debt. Okay, so that's good. So they have 20 million available on the line of credit. So that 30 million line of credit, only 10 of it is being used. Four and a half to 5%, not bad at all. I mean, that's a great interest rate. This is such a safety company. Notes payable. Hmm. Prepaid some debt. So they owe 30 mil in 2028 and 30 mil in 2029. So their special dividends might not be as high those 2 years. But I'm guessing they're gonna extend some of that. But what's crazy is they can. If they want to in a year, they can just pay that. Like that's not even like, oh man, this big event's coming. Like they just are clearing money. Lease payments, income tax. Yeah, we got it. 52 mil income from operations. It's just so nice. Okay, so 52 mil was income from operations. So 10 mil paid off debt, and then the rest went to dividends. That's way up there. But they made 40 mil of whatever. So they have 52 they can play with each year. Look at this though. Income from operations. Hmm. A little tiny bit on the down. The franchising on the up, which is the main thing that they are. Their stores are on the up. It's all that other, it's that leasing revenue. It's going down, which I guess is also pretty probably good. If store owners don't need to lease stuff from corporate, it's because they have their own. So I guess that means more and more owners are doing fine. Hmm. Wow. That's it. I mean, they're just getting, this is such a long video for like not that much interesting revelation. It's just like we're just gonna keep getting paid from our stores and whatever we make, we're just gonna pay out. Man. Ah. And they're really not gonna keep anything on the books. I'm wondering about the management team now. Mark. Like just take me like to their wiki. So tell me about Brett Heffers. It's five. Oh, check this out. Computer games and video games. They tried and said, never mind. Gotta love that. There you go. There's their leasing income. It's from a subsidiary, building supplies leasing company. So that's the subsidiary is the freaking company that's making the leasing income go down. So just kill that thing. So Goodwill is still the lion's share, and Winmark is second with a 6% share. In 2013? That doesn't tell me anything. Freaking 2013. If they were already 6% in 2013, honestly, that's probably pretty good. March. John Morgan. Rescued from the precipice of bankruptcy by making sure that franchisees could actually afford to own their stores. getting people in executive seats he trusted. Hey, in 2001, they had income. So it was losing money before. So Brett has been there since 2016. Yeah, that's encouraging. This John Morgan guy holds the most shares in the company, and well, at least at the time. That's actually probably not. So tell me about John Morgan too. John Morgan, Winmark. No, tell me about him for real. Guru Focus. There's John Morgan. So they had a bunch of franchises that were just lying and costing the company some money. When was this written? 2013. Gosh dang. I wish I knew more than that. He owned 34%. He has only received one stock option. So he bought 1.1 million shares himself. So that's a good sign. He got all of his pay in stock. He's from Omaha. Of course he's from freaking Omaha. How big do you want to be? There is no wish list. We want to build a good business at a reasonable rate for everyone. You like to hear that. He has no exit strategy. Gotta love that. Diversification is overrated. Gotta love that. Wants to keep the company public. He kept his salary the same as his fellow executives. Raised from a blue collar family. Went to University of Nebraska. Worked at IBM. Because he wanted to make money. He worked for a startup that failed. He used equipment. Okay. He brought financial statements. Oh my gosh. I think I like this guy. Data serve. Accounts payable company. So just a classic IT. He did not love it. Resources. Leasing high tech. Sure enough, this guy likes to lease stuff, getting used stuff to people. Then they sold the company. 15 grandchildren. Plays a lot of poker. This guy seems like a normal guy. That's what you really want to see. Like, you just don't want to see like a plant from a guy that has his whole career in Wall Street and or like consulting. Like, you want someone that's actually a business person that does things for the good of the business what is that's so stupid that he says that because he doesn't even hold on to his cash. He cares about shareholders and employees though. I mean, that's great too. I actually relate a lot to that uh statement about being good at strategy. I wish I knew if he was still a shareholder. Well, there you go. So he sold some in 2015. He bought a bunch all throughout his tenure as CEO. And he sold a bunch after he left. Looks like he sold too early, man. Look at that. They're hanging down at 315. Stop. He still owns 900,000 shares. I don't know what this final share means. He hadn't sold a share since 2015. I mean, that's crazy. That's a really great sign. Jeez. His most recent trade is when he bought, wait, okay, the sale of 800,000 shares. So he cashed in about 70 mil, but he still has, so he sold almost half of his shares back in May. About 40% of his shares. That's not bad. He's already done with it. I mean, he probably wants to hold on to the rest. So then tell me about this new guy. Oh my gosh, it took me to a wiki about CEO. I want to know about Brett Heffes. You're not going to tell me anything about this guy? The business of resale. That's what we want to hear. That's why we're here. Okay, start here, April 24. Sold 3 mil. And the exercise options. So you really only cleared 18 and 1.8 mil. Gross profit margin of 95%. So profitable. So its PE ratio is high, even though its dividend growth, like its dividend is small, its revenue growth is small, the share price has performed meh. I mean, we'll see in a minute, but like I think it's being priced a little higher because of the recessionary environment that we're in. Current dividend yield of 3.39%. April 25. Show me the 1 year. I mean, they've basically flat over a year, almost 30% higher on a 3 year. Oh, 54%. Okay. Okay. I mean, plus the dividend, you know? It's not a bad stock. It's just not. His salary is fine, I guess. He's been the guy since when? Since 2013? 16 and he's still there. You gotta like that. There's Brett. Hey, Brett. Okay, so he was at Winmark before he even became the CEO. Big on sustainability. I mean, you like it from an ethical perspective. It's a good business from a values perspective. And you're, of course, as a franchisee or a franchisor, you are helping create entrepreneurs, which of course I believe in. Before that, he was on the board of some stuff, CFO, this random company. He went to Boston College. I've been there. Analyst for Citigroup, investment banking. Twenty-two years at a single company. That's about as stable of a company as you can get for as low of a valuation as they are. I love that. The stability of the leadership, love that. The leadership believes in this company a lot, love that. And this is not a sexy company at all. Ain't no one talking about freaking Winmark. I'll tell you that for sure. This would be fun to listen to. What do you sound like, Brett?
Growth happen on a but ours we are focused on value. If you our two largest brands are Plato's Closet and Once Upon a Child, our price points, our average retail price for Plato's Closets right around $10. It's right around $5 for Once Upon a Child. I don't believe there's really a lot of people, or very many, if any, at scale that can sell $5 items, profitably. So we have this interesting combination where we're doing great things for the environment, but we're also providing really strong economic benefit. And I think it's one of the best examples of sort of shared value that I've seen out there. And that's just a framework where, the social value you provide plus the economic value you provide is really coming up with this incredible shared value concept. So
Love that. Man, big community win. You talked about 70. When was this done? Okay, July 2023. Where's that question? Oh no, get me out of here. Jeez. What is a reasonable growth expectation for investors? If you look back at our history, we had about 800 stores when I started. Now we have 1,300 stores. That's a 62% growth rate in almost 21 years, which is not all that impressive. That's what I'm saying, Brett. But it's a little over a 2% store count growth rate, 2.3%. somewhere in there. But our system-wide sales have gone up almost 400% to a little over 1.5 billion. So what's worked for us is focusing on the stores that we have. Our current store owners during that time have gotten dramatically better, and that sort of growth rate in network sales is somewhere around 7% with 2.3% store count, 7% sales growth. So whether it's 5 or 4% might not seem all that impressive in terms of sales growth year over year per store, but over 21 years, it's enormous. Obviously, a 400% gain. So if I get on stage at our franchisee conference, we had 1,300 people there. Now, if I get on stage and talk about how many stores we're going to add, no one in the audience cares. They care about their own location. Are they making money? My primary responsibility is to them. They are the partners. We want them to be profitable, of course. Now we want to grow. We have new ideas, new concepts. And if we could find more qualified people, we'd have a lot more. It's definitely going to be more than one or two a quarter. Hmm. We want to add as many as we can, but it's getting a qualified applicant that is their bottleneck. So that's interesting. Sustainability. Last year, they extended the life of 169 million items. You gotta love that. They are the market leader in all four categories that they're in, and the highest average unit volume in all of them as well. So that's great. There's a lot of other companies out there in this very big market, and there's been competition since we started. When I got started, it was about eBay and Walmart selling $4 shirts and how that's going to help us. And it was eBay's going to put you out of business, and there's online people, like I was talking about earlier, doing their own side reselling, going to put you out of business. It honestly doesn't matter. We have a model that if our stores run the model, they're going to be just fine. Two things that people don't talk about is that the donation market is massive. There's a ton of people bringing their stuff. That's such a great point. We want to be the first stop. Before you go to Goodwill, come here and we'll pay you cash and then take the rest over to Goodwill. It's a good proposition, of course. The other concept people don't talk about is independent thrift stores. There's an independent thrift store in every town, but there's a heck of a lot more of them than there are probably the other locations put together. But they're not organized. They're not as well capitalized. There's a lot of weak ones out there. So they don't view thrift stores as a big competitor to them. Are there things out there that you believe the broader investment community has mistaken about Winmark? Or is it more of a variation that, or is it more a variation of the you're still largely under the radar of a lot of shops? Interesting. We don't want formal coverage. So they don't want analysts. So they're not in bed with Wall Street. You gotta love that. I think it doesn't make sense for us. We have 20 shareholders that own 71% of the company. That's crazy. So if people want to get a hold of us, they call, and Tony or I will return the phone call. It's pretty easy to get a hold of us. We're not looking for coverage. We're very focused on running the company, and we think that's going to deliver the best outcome for any shareholder. And I don't have any issues with how other companies do it. You got to love that. He's not out here with a vendetta. He's not out here to diss on Wall Street. He's just like, that's not the game I'm trying to play. The only thing I would say in terms of what shareholders, it's not that they get wrong. It's I don't think they understand how we've set up the company in terms of managing it. I don't mean to be arrogant. I want to be really clear, Jim, but it's just something I've acknowledged after being a professional for 30 years or so. It's like we have something that most companies crave, and it's clarity of purpose. Like I mentioned earlier, we're Winmark, the resale company, and our mission is to provide resale for everyone. When you have a mission that is pure and is communicated often, it takes the emphasis off of one person and it focuses on the company and the opportunity. I really feel that the work that we've done over the past couple of years, it's changed the entire trajectory of the company. It's changed for the positive. It's changed the culture, the performance, accountability, and we got this new store activity that's been increasing a little bit, and it's really helped with the marketing. I know that I had an impact on redefining the mission, but that's my job. It's not some unique skill that only I'm capable of. I think one of our shareholders had this quote that I love. The quote was, I am wary of companies where the CEO makes themselves part of the show. And I think you know the person who did the quote because it's you. Okay, thanks for saying that, Jim. I don't know if that was yours or you stole it from someone, but I love that quote because I think sometimes people in my position just can't help themselves. They have to be a lead in a story. And hopefully, in your prep work, you reviewed our materials, you saw our taglines, and you see what's front and center is the mission. I would say, frankly, for a company our size, which is very small, from a headquarters perspective, we have incredible executive depth. You can call and have the same conversation we just had these last 25 minutes with our CFO. He's been with us for 15 years. With our COO, she has one of the best stories in specialty retail that no one's heard about. She started with us at a store manager as a store manager at a Once Upon a Child. That's pretty cool. I have three or four other people on sort of our weekly management calls that are just unbelievably talented. And there's too many to name, but we're talented. Average tenure just shy of 10 years. It's pretty amazing. Strong employees, clear mission, executive depth. It reduces the risk for shareholders, reduces the risk for franchisees. That is like such a great summary of this business. Reducing risk. Man, you got to feel safe in this business, right? Try to promote from within if at all possible. Our renewal rate is so high. It's 99% over the last 10 years. Oh my gosh. I wonder how that compares. What is Subway's renewal rate? Oh, no, tell me. What? percent of Subway franchises renew. Okay, they won't tell me right now. How about McDonald's? 90. Oh no, that doesn't actually tell me. Okay, I don't know, but that's 99%. No one's gonna be higher than 99%. I mean, that's as high as Chick-fil-A. That's crazy. Like you think about brand power, right? And like you think of Plato's Closet, you think of Once Upon a Child, like you go in there, it's kind of cramped, right? Same with a GameStop, like a small square footage operation. It's not quite off-putting, but it's so unassuming. Like you just think, oh man, wouldn't it be so much better to be a TJ Maxx, or like a larger place or a best, you'd much rather be a Best Buy than a GameStop, much rather be a Marshall's than a Plato's Closet. But these small footprint stores, like it's just that much easier to be profitable. And they really, like, they know that they're not a sexy business, not like, and so people have to win. Like if they don't, they're not gonna grow. That's just a great, I mean, the tenure of the executive team and the confidence in the leadership of this company, it's astounding. And then 99%, I mean, that's kind of crazy. The people that are coming into the system today, they're going to be in the system after my career. In my role, I have a responsibility to help organize the company in a way that's not relying on me. Everyone's bought into that. Going back to your question, it's not what people get wrong, it's that they don't appreciate about us because we are not out there talking that much about it. Well, you could talk a little bit more about it. I'm glad you're not playing the Wall Street game, but I kind of wish you were playing it just a little bit more. But I mean, it's great. They're not some private equity vulture company. They're just such a real, authentic company. Something that is built to last. And Jim's like, yeah, that's great, but we're an investment company. I've held your shares for 15 years. I don't think I'm a top shareholder, but you have an interesting dividend story. You started with 10 cents, 2 cents, now you're at 80 cents. And we just saw their 10K. Now they're up to $3 and something. But you've also done buybacks. You're very profitable, that like that cash flow is coming. How do you think about dividends and buybacks? Sure. We have a philosophy that we've shared with ourselves internally, with our board, and our shareholders. There's 5 or 6 bullet points. The first tenet in the capital allocation philosophy is we're going to focus on running the company. Great. So, as much as we need for the company, we're going to use. Of course, the other is that we don't want to sit on excess cash because we think that is value destroying. That's fascinating. So we saw that, right? On their balance sheet. We saw they don't sit on cash. They don't. We don't have any CapEx. We're generating capital in excess of the requirements of the business every week. So they're always making, because the franchisees have to pay them weekly. So they are free cash flow positive, not just on a yearly basis, but literally on every single weekly basis, which is pretty awesome. Like there's never a debt payment or anything that they're like, how are we gonna make this one? Like, oh, great. Good thing we made more than that this week. Crazy. We have three primary uses, is what it boils down to. We pay down some debt, but we like having modest amounts of leverage if the rates are proper, because we think that makes sense given the 99% renewal rate, the predictability of the business. Like it's such a safe business operation that they feel comfortable utilizing debt, which we talked about. They have kind of high debt relative to the cash that they keep on hand, but it's pretty low debt relative to what their income can afford. They're paying 3 million a year in interest expense and they make 50 million a year. That's pretty impressive. So it's like, yeah, the primary avenues for us are dividends and buybacks. And we like the quarterly dividend, but we don't want to get it too high because that hurts our flexibility. So just like we saw, they're keeping their quarterly commitment relatively low, and then at the end of the year, they can decide, do they want to buy back some of their stock or do they just want to pay a special dividend? But they're totally like they're like a co-op company. Like they're like, how do we share the love with our employees and with our shareholders? Like we want everyone to win. And it seems like they're pretty calculated and modest in the way that they do that. And we saw their interest rates. They're like, hey, we'll use some debt as long as if it's a good rate. It's like, yeah, in 2024, you're paying 4.6%. I mean, that's crazy because T-bills were paying 4% in 2024. So, like, no matter what they do with the money, like it's almost like there's no way that you're going to end up regretting that decision as long as you have an efficient business, like that's pretty compelling. This is actually such a quality interview that we stumbled upon looking into Brett Heffes. We're pretty comfortable paying on an annual basis. So it's just like, where do we see value in the company versus as far as like, do we want to buy stock or do we want to do a dividend? Back in 2012, 2013, 2021, they were buying a lot of their stock. And he said ultimately that's probably better long term than special dividends. But recently, the past year or two, they've been leaning more towards the special dividends. So maybe they feel like for the value, that's the better move recently. Because I've just spent 4 minutes talking about capital allocation. That's probably more than I'll spend the entire quarter. We just have a formula. We kind of go through it. We know what we have a strong view on and what we're worth. Gotcha. So they have their own way of internally valuing the company. And if the company's worth less than that, then they buy the stock. This stock, I mean, we talked about how this business is such a stable business, right? We teed up this video talking about recession and tariff impacts. And what are some businesses that competitively or comparatively in the competitive market could be in a better position? Like, man, what about resellers? So they're resilient from a downside scenario perspective from the business itself, but that's not just the nature of the business, it's also their executive team similarly, right? Like such long tenures from the longevity of their franchises. Like the longer that they stay in business, the better they become at those businesses, right? Shoot, I kind of want to I kind of want to start you want to start a franchise? Man, just call Brett. He said he's available, man. Geez. Um, but then how they're managing their money also, like they just are very and their shareholder base, right? 20 shareholders that hold 70 something percent of the company and the float of those shares that are actually publicly available is so small. And the company is supporting it, right? The company's like, we'll buy more of it. And then the long-term shareholders, like we just looked at, that other guy, whatever his name was, John Morgan, who saved the company, he's like, I don't have a sale plan. I don't have an exit plan. Like, of course, then he sold freaking $67 million worth, but he hasn't sold in 10 years. Crazy. Oh, cool. They're about to end. And then he says, if you don't mind, can I just say one thing? What does he want to say? I hope everyone knows how much I care about this industry. I think we are a great business. But, oh, classic. He was going the same way I was going. He says, but we had 2,800 open territories in markets all across North America. And if you're interested, go to winmarkfranchises.com, learn about our concepts, fill out an application. We'd love to talk to you about bringing our concept to your community because it's really special and we think we can do wonderful things together. You know, what do y'all think? You gonna do it? I'll leave that there for you. Very, very compelling. This one's from even a year before, so I'm not even gonna go into this one. Hmm. Even the way that they operate the business is like he's like literally we give them the plan. If they stick to the plan, they're gonna be just fine. It's just so honestly, I opened this up talking about my experience reselling and talking about how I'm coaching other people and doing reselling. And I feel very similar. Like I can, with a good conscience, sell a coaching service to people in the resale space because I know like 100% that they can and will make money. Like they will make more than they pay me, right? Because I know the resale business. And it really is formulaic to a certain extent. It's like, here are the to-dos, here are the not to-dos. Keep going, flywheel over time, and yeah, you're going to make a lot of money. Like, and so for them to have a similar, it's just such an easy business model that people can, because because literally people are like, I was going to take this to Goodwill. Like people don't want to sell their own 5, 10, $20 pieces of clothing. Like they're like, I might as well just get rid of it. I'm like, hey, if I can show up with a wheelbarrow and dump it on your desk and you give me $70 or $40, like great, it's 40 more dollars than I would have had. Like they have an infinite supply of super cheap inventory. And it's just it's hard to ignore that. I mean, what a safe company. Super well supported industry, very recession resilient industry, super well supported shareholder base, super well supported franchise mix. And if you want to go back to when John took over, they were at $5 a share, and now they are up 7,300% since then. So, over the past 5 years, they're up another 178%. I should be showing this to you. Compared to the SPY, the S&P 500, up 107%. So they have certainly outperformed on a long term time frame, overperformed, and even on a 1 year basis, they're 5% down a year ago to now compared to the S&P 500 just up 3%. Okay, so maybe a little bit of catch up. Maybe they got a little bit overheated. But from a valuation perspective, again, that 33 PE is a little higher than most retailers, but they're yeah, I mean it's a 30 right now, a 30 PE. But part of that's that they pay a dividend. So they have a yield that you're factoring into that boosts their usually they're the PE they're going to trade at, whereas a lot of other retailers don't, like an Amazon, or at least Amazon didn't used to. Maybe they do now, I don't know. But they're just so stable. They're so stable, and hypothetically, there's still a lot of growth they could have. I mean, they're not playing the Wall Street game, so I don't know if they're in a rush to achieve that growth. But at a $1 billion valuation, it's a very inexpensive company to be a part of. And they have, at the time of that interview, 1,200 stores. I forgot, I don't remember how many they had in the 10K. Let's see if I can find it again. 1,350 as of end of December 2024. So that's 150 more stores that they put up in about a year and a half. They had about 100 more that are coming next year. And they said they had 2,200 more locations available. So hypothetically, they could be almost twice as big as they are now. And from an earnings perspective, there's just not that many uses of capital that they have need for because they don't own the stores. So they're just qualifying super well capitalized franchisees that can afford to pay the costs to do the business, right? And they're like, hey, just give us 25 grand. We'll call it a day. And then you pay for all the stuff that you're getting. And Brett's like, hey, we got other ideas, stuff we might do, whatever. But first and foremost, like we've got a lot of markets open for these stores. It's not, I mean, it's not bad to be patient. Not bad to be patient. And the more that each store continues to operate and make money, you got to figure over time that that's going to help them grow their store base if everyone's winning. I don't know if the company itself, you know, 5 years from now, like I think it would double faster than the SPY would double. Like in the past 5 years, it's almost tripled. It's almost doubled the SPY. Is it going to outperform quite that strongly again in the next 5 years? Maybe not. It might be like a 1.4x of what the SPY does. But I think the outperformance is very plausible based on the concentration of the share count and the low base you're starting from. It's always easier to have a high multiple on a company that has so much value still to go. Like they could go international, for example. You start like they don't have any in any country other than the US and Canada. So with their format, can they empower a reseller in another country to teach them what to buy and what not to buy as far as clothing trends? Like, yeah, they can. Of course they can. They can probably do it better than anyone else because they've been doing it for 30 years. So it doesn't really matter if like, oh, there's already a thrift shop here. It's like, yeah, a thrift shop full of trash is what they have there, you know. And you've got resellers that are poaching places like Goodwill and thrift stores. Like they're getting all the good stuff and buying it right as soon as it hits the shelf. So you can't get anything good at those places. So if you want to get something that's actually a name brand or good, like you got to go to a Plato's Closet or somewhere like that where you're paying closer to retail price. So the margins are just pretty nice for franchisees. It's a win all around. It's a win all around. I think the upside's there mainly just because of the concentration of stock ownership. And but I think more attractively about this company is I think the floor is quite high. They have the cash flow every year to support this company. If it ever has a dip that is outpacing what they think the company is worth real time right now, they're going to support it. And if they don't, like, and if the stock does well, guess what? They're also going to be paying out a dividend. So like you're really protected from a lot of downside risk in this company compared to many other companies. There are many companies that could easily be worth half as much as they are, if nothing else, just from a multiple basis. But I have a hard time imagining Winmark depreciating that much in value, especially when a recessionary environment and a high tariff environment are really, there's still net probably tailwinds, or sorry, net headwinds. Like I don't think it's necessarily good for them, but comparatively to other companies, I mean, way less so. 100% of their product is sourced locally, and people bring them to them and basically offer them product for free. It's just hard to get a business better than that. And they're not making, again, they're just making 5% of the revenue. They don't own all the stores. So 95% of the upside is going to each franchise operator. But 5% of the upside is going to Winmark. So again, the upside, not as huge, but the floor so high. And I think that is attractive in an environment that we're in. All right. This is longer than any of you guys were bargaining for. Thanks for looking at a 10K with me. Fresh, trying to understand a company a little bit more than I did before. If you want to get into reselling, hey, maybe talk to Winmark. Okay, it's just 25 grand to franchise with them. Of course, you got to be ready to spend a lot more on building out the store as well. If you don't have all that, you want to bootstrap a resale franchise, you can talk to your guy here at school.com/reselling. If you're looking for an active manager, a portfolio manager, the most trustworthy financial advisor on YouTube, you can talk to me anytime. Shoot me an email, give me a comment. I'll be around. All right. Thanks. Talk to y'all soon.